Hi guys, welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, all of us will be saying thank God it's Friday, given the kind of week that we've had. Week to date, the Nifty is down 2.5%. We are at somewhere around 23,500 mark. Even on the Nifty Bank Index, we have broken below all the key support levels. So yes, not been a great week. And all of us will heave a sigh of relief as trading ends today. But the setup also looking negative this morning. The GIFT Nifty is hinting at another weak start for our markets. Although in the pre-open we are fairly flattish with mixed cues. But let's see how things really pan out. Lots to digest. We had TCS coming out and kicking off the third quarter earnings season officially. It was a mixed bag set of numbers, but commentary was fairly upbeat. Because of that, the stock has also earned an upgrade from CLSA. We'll also get you views on TCS and how you should be approaching this stock now. Lots of other stocks reported numbers that will be in focus. Of course, all your stock related queries will be on our radar as well. So keep your queries coming in on our live feed. We'll try and get them addressed by our experts. But before we move any further, let's quickly take a look at the top headlines at this hour. Wall Street remains shut in a day of mourning for former President Jimmy Carter, but futures trade lower ahead of the monthly jobs data. Asian markets trade with losses, while the GIFT Nifty, as I mentioned, is suggesting another day of weakness for our market. Crude prices gain over 1%, with Brent rising back above that $77 a barrel mark as a cold snap in Europe and the United States spurs demand. Meanwhile, gold prices slip off 4-week highs. And TCS kicks off the earnings season on a mixed note. Dollar revenue for the third quarter declined by nearly 2%. Margins also miss money control estimates, but deal wins cross the $10 billion mark. CLSA upgrades the stock, sees multiple growth vectors going forward. Well, those were the top stories then, but let's quickly take a look at what the cues are looking like and how or what the market action was like yesterday. We ended near the day's low. The Nifty, of course, slipped below that 23,550 mark. We have been able to sustain that 23,500 mark, but 23,460, that's the December low. And if we fall below that, perhaps that would confirm that the trend is actually only towards the downside. Frontline indices fell nearly 1% for the week. As I mentioned, we are down 2.5%. The mid-cap index was down for the fourth session in the last 5 sessions. Nifty, FMCG index, all the other indices were in the red yesterday. The Nifty Realty index was down nearly 3%, but FMCG managed to keep its head above the water yesterday. Stocks rose in a weak market. Chemical stocks as well were surging on the back of a hike in US refrigerant gas prices. But of course, SRF has issued some clarification on that. We'll be talking about that. Let's take a look at the FNOQs as well. The put call ratio climbed to 0.92 vis-a-vis 0.83 in the previous session. And talking about some of the stocks that will be in FNO ban. No new additions or deletions, but 5 counters in the ban list today: Bandhan Bank, Hindustan Copper, L&T Finance, Manappuram Finance and RBL Bank. In terms of flows, FIIs remain net sellers. We saw them selling shares worth 7,100 crore rupees in the cash markets, while DI buying support continues. DIIs in fact bought 7,600 crore rupee worth of stocks in the cash market. But on that note, let me also bring on board our technical guest for today. Joining me is Jay Thakkar, Head Derivatives and Quant Research at ICICI Securities. Jay, we are speaking for the first time this year. Wishing you a very happy new year. Although we started the year on a good note, the party seems to be over for now.
Hi, very good morning to you, Nandita, and wish you all a very, very happy new year. Also on behalf of ICICI Securities, and I hope that, Nandita, this calendar year 2025 provides lots of opportunities to the investors as well as the traders. I mean, this year we are seeing increased lot size in the FNO segment, especially the index options. I mean, we had that lots of news about the derivatives in 2024. So we're starting this year with an increase in lot size out there and increase in volatility because of which as well. And if at all there is correction, as you rightly said, party seems to be over quite soon. So I mean, it would provide going forward an opportunity to enter at the lower levels as well. So I would be suggesting the investors to be ready and do the homework, start your homework rather.
All right, investors must do their homework and be extremely cautious at this current juncture. But on the Nifty in particular, do you expect the December lows to be taken out pretty soon? That's 23,460, and post that lower levels that we saw in November. Do you see a chance of that happening? I know it's very difficult to call a bottom in this market, but what are your expectations? Do you think a sustained downtrend will only be confirmed if we go below that 23,460 mark?
Well, yes. See, for a confirmation, definitely, Nandita, you would be requiring the levels to break. Till then, it's all, what you anticipate in the market. So definitely confirmations will come once, 460, after which 263 levels, on Nifty. So 23,460, and thereafter, subsequently, 23,263 breaks, it would be further confirmation of a downside. We can get Nifty to 22,800, 22,500 levels as well. And once it breaks, you would be seeing, and people on the street would be talking about those levels as well. Till then, what's happening is Nifty somehow is trying to, on a closing basis, manage 23,500 in yesterday's weekly expiry. Also, we saw the same. But on the flip side, 23,800 to 24,000 levels are taken off on a closing basis as well. So it's in a very tight range, I would say, Nandita. But what's the difference between Nifty right now and Bank Nifty is that Bank Nifty has broken not only its November lows, Nandita, but also the August lows. So that's trading relatively weaker as compared to the Nifty. And in the previous two occasions, when Nifty had fallen from 26,300 until 23, 300 levels approximately to also, when it started the fall from 24,800, Bank Nifty earlier had relatively outperformed. But this time around, it's like underperforming the Nifty in the overall fall. And that's where the pressure is coming from initially.
Right, that's the view then. Of course, Nifty Bank Index violating major support levels and in fact breaking August lows as well. But let's talk about the IT pack. The spotlight will remain on this sector today. TCS has kick-started the numbers, mixed show, but it's the management outlook that has impressed not just the brokerages, but I think even a lot of experts who were saying that, going forward, it would be a time of recovery for IT names. But very quickly, just taking you through the numbers, profit came in higher by 4% on a sequential basis vis-a-vis expectations of 3%. Revenues were a slight miss, down 0.4% on a quarter-on-quarter basis. Dollar revenues were down almost 2%, much below what CNBC was expecting of 0.6% decline. We saw a near 2% decline. Constant currency revenue was flat on a quarter-on-quarter basis, but even margins, although they have seen some bit of recovery after 2 straight quarters of decline, but at 24.5%, margins were below the money control estimates of 24.8%. Attrition rate has gone up slightly. Net headcount has gone down after 2 straight quarters of net additions. And the deal TCV, that was one silver lining as well. The deal TCV came in above that $10 billion mark, up 17% on a quarter-on-quarter basis. And if you look at the YOY, growth in deal wins, that's been 26%. So yes, 17% on a quarter-on-quarter basis, quite good. But in terms of management commentary, they have said that they saw negative CC growth or cross-currency growth, constant currency growth across major geographies. But, they've also said that in terms of discretionary demand, there are early signs of revival. And the management has also pointed out that they will be looking at plugging the gap arising of the absence of revenues from the BSNL deal by looking at other international and domestic deals. So yes, there are plans in place to fill that gap arising out of the absence of revenue contribution from BSNL deal. But if you look at how the street is reading into the numbers, CLSA has upgraded the stock to outperform. Target price has been raised to 4,546 rupees. They said that multiple growth vectors are there for the company going forward, and valuations also on a relative basis and a 5-year average look pretty much attractive. In terms of demand commentary, they have said that the commentary has improved materially, and of course they've also noted the sharp pickup in order book as well. And artificial intelligence, of course, another positive cog for demand going forward. Even other brokerages have maintained their faith. Jefferies has a buy call, target price in excess of 4,700. But looking at the price movement of TCS, looking at the last 2 years, IT stocks have done extremely well, outperformed the index as well. and the second half of 2024 also pretty good. But how would you really look at TCS on the charts in comparison to other IT names? Because Infosys, if you see that, it has outperformed TCS by a wide margin. Do you expect TCS to now start playing catch up to Infosys, the kind of movement Infosys has seen?
Yeah, you rightly said, Infosys, maybe HCL Tech, and all the other mid-cap IT names have also, outperformed the, relatively, TCS as far as, the price appreciation is concerned. It's just the Wipro, which mainly laggard, I would say, Nandita. And I think that TCS might continue to further consolidate until unless 4,500 levels are not taken off. I don't see TCS outperforming the Infosys in the short term. So I think 4,500, I mean, if those levels get taken off, I mean, TCS has a fair chance to do that. Unless that, it would still continue. And what's holding up TCS and why it's consolidating and what's holding up TCS, Nandita, importantly, is the rise in the dollar index. I mean, till that continues to rise, I mean, it favors the IT at least in the short term.
Right. Look at the IT pack. We've had the first ticks. Markets have opened up, and Nifty IT index is up 2.5%, and all thanks to TCS. A 4% uptick, in the share prices of TCS. In fact, the top 5 to 6 movers on the Nifty are from the IT pack. Tech Mahindra 3%, Wipro 2.5%, Infosys 2%, HCL Tech 1.5%. So yes, it's the positive management commentary in terms of discretionary demand and how they are seeing early signs of revival there. That has perked up the entire IT pack, because the commentary that came in prior to the third quarter was all based on how US BFSI and the recovery or early signs of recovery in consumer discretionary demand there would aid recovery, and now the commentary coming in from TCS is only confirming that. So yes, on the back of that, entire IT pack is up and about in trade. If you look at the Nifty, it is getting strength or support from the IT pack, although the global cues are negative. SGX, in fact, GIFT Nifty, pointed to a negative start, but we managed to start the day on a positive note for now. No big moves, but a 50-point uptick on the index below that 23,600 mark. But let's see whether or not this sustains or not. Sensex as well, 170 point higher, but the mid-cap index has started the day on the back foot, 0.2% kind of loss coming in on that index. Even the advanced decline ratio is still tilted in favor of losers. In terms of other movers, let's talk about some of the other sectors and see how they are faring. Well, most of them are in the red, and looking at banks, below that 49,500 mark. Autos under pressure. You have energy, FMCG, all of them under pressure. Metals as well, 0.3% lower. So barring the IT pack, all the other indices are trading in the red. So no change in sentiment really, but it's the IT basket that's keeping the index afloat as of now. In terms of laggards, you have stocks like Indus Bank, Hindalco, NTPC, Adani Enterprises, Bharat Electronics, SBI, all of these stocks under pressure. So, yes, all in all, a muted start, but of course, the story of the day, IT stocks led by mixed bag kind of numbers, but upbeat commentary from TCS. And don't forget that TCS has earned an upgrade from CLSA as well, with a very sharp or good, bump up in the target price as well. Looking at the open, Jay, first of all, any stocks that you would be recommending for our viewers?
Well, definitely. And as we are discussing the range, 23,500, Nandita, I mean, on a closing basis, that's holding. I mean, that's almost like for the fourth day is what we are seeing in this fall. That market is, holding up 23,500 on a closing basis. Until those levels are held, I mean, the consolidation continues. And thanks to IT today, that's holding up. And because of which, Nifty is up. But then, yes, broader markets would be. Now, I have a couple of recommendations. The first one would be on Rathi Industries. I mean, Rathi Industries, is down by 1.5% today, but I think it's good buy on dips. Opportunity. The reason being is that we saw yesterday chemical stocks really outperforming the market, maybe SRF, Navid Fluorine, or maybe Deepak Nitrite, name it, and we had that kind of a move on the upside. And Rathi Industries has shown that kind of a positive divergence on the daily charts, and it's looking quite oversold. It's ready for a bounce back. Also, derivatives data suggests that there is a lot of shorts build up out here. So there is a high possibility of a short covering in Aarti Industries. Hence, it's trading around the levels of 498, 408, sorry, Nandita 408, 406 range. I think, stop loss below 495 could be kept, and one can target around 435, 450 from bounce back. Second buy recommendation would be on Bajaj Auto, and it's trading around 8837, 8830 range. So maybe 8830, 8840 range one can buy. There is a strong outperformance as far as momentum is concerned. I mean, it's since November is showing that positive divergence. It's been almost 2 months, Nandita. We are seeing that. It's quite long, it's quite stretched. We're seeing good amount of short that's got build up on the Nifty Auto, especially the two-wheeler names now. Four-wheelers have already started to bounce back. So I think two-wheelers have not, especially Hero and Bajaj is showing some signs. So relatively, there is a good risk reward out here. One can place a stop loss below 8600 and target bounce, sharp bounce until 9200, probably, 9400 as well. So these are the two stocks on the short covering point of view, which I think can be looked into. And one stock, I believe that CG Power can be sold on bounce. It's trading around the levels of 676. I mean, it's a new entrant in the F&O since last series. I think, Nandita, if at all you get a bounce near the levels of 685, 685, I think one can go short, placing a stop loss beyond 700, targeting around 650, 630. Positionally, reason being is that, initially, I mean, all of those 40, 45 names which got entry in the, F&O in December series, initially for a week or so, they saw that long build-up. Post that, most of them have seen a sharp decline and as well as short build-up. There's a short build-up. Technically, it has shown that negative divergence on the daily chart as well as a trend line breakdown. So high probability of a downside in CG Power.
All right, that's the view. Those are some of the recommendations. Three stocks, CG Power, Bajaj Auto, and Aarti Industries. But let's talk about a Tata Elxsi as well. Numbers were underwhelming, to say the least, and the stock has also been downgraded by Morgan Stanley. Target price has been cut from 6,500 to 6,000 rupees. The stock is down 6% or thereabouts. Last 1 month, the stock has shed almost 20%. Do you see any signs of bottoming out, or do you think this downtrend will sustain? Has there been any kind of a major breakdown on the charts?
Yeah, absolutely. Nandita, it was quite at an important support level, I would say, which has broken down it has broken with a gap today. So that important crucial support was of 6,300, and that has got broken now with a gap. So now, until unless we don't see a close above 6,300, 6,350, probably we give 50 points more on the upside in order to avoid the noise or the source, technically. I think the trend has clearly, confirmed on the way down. I mean, the reversal has been confirmed. The previous swing low was also around the levels of 6,300, Nandita. And then overall trend has been sideways to negative since August 22. I mean, this was one of the outperformers, until 22 end. In calendar year 22 end, I mean, one of the best as far as IT performers are concerned, mid-cap IT names. But then, the stock has gone sideways to negative, and I think that underperformance continues even from the momentum point of view. So I think, a long-term support for this stock is somewhere around the levels of 5,000, which is still, 15% and more from here on. So I don't see a reversal until 6350 levels are taken off.
Okay, that's the view on Tata Elxsi. But I want to get in your thoughts on an IREDA as well. Numbers came out yesterday. Asset quality has seen some deterioration. And because gross NPAs have risen by 30% in the third quarter, the stock is down 2%. But the stock has been off late. If you look at the 6-month returns, you'll see that the stock has given negative returns. But over the last 1 year, it has been it has almost doubled. So this recent deterioration in stock movement, do you see that as a buying opportunity, or what kind of an approach should one take for this particular stock? I think I spotted a query as well on our feed. We had a query as well. Shatabdi Ghosh wanted to know what will be a good entry point. Do you see an entry point now after the kind of correction it has seen?
Well, again, I would like to say as a disclaimer that it's a non-FNO stocks, and generally I track more of FNO stocks because more you see the actions out there as far as trading is concerned. But nevertheless, I would say that Nandita, see, this stock from the IPO price is still 7 times. 30 is what I remember. I mean, where they had come out with an IPO, it opened almost double, 50 at 60, 50 or 60, 80 to 100% up. And since then, we've been seeing a clear up move. I mean, it went until the levels of 300 as well, so almost 10 times from its IPO price, rather not the listing price. But then since then we have been seeing that underperformance since July 24. So it's just, I mean, not even 6 months of consolidation or correction, I would say. It corrected sharply, until the levels of 190 from 200 and 300 or so, almost like 30%. But then after a very good run up, I would say. So that was a clear profit booking. And the bounce since that has not been that, impressive, I would say, technically. I mean, the bounce has come on weak momentum. And generally, whenever the bounces are on weak momentum and it shows less of strength, indicates that, it's either going into a consolidation, it's just a bounce back. It doesn't show that signature or a sign of, bottoming out or maybe a reversal. So that's not visible. And my stance would be to avoid.
Okay, avoid. That's the call on IREDA. Before I move on to other queries, I want to get in your thoughts on some of these CGD companies, MGL, IGL, Gujarat Gas. Of course, there is news flow that domestic gas allocations have been revised upwards by 26% for MGL with effect from 16th of January. And the share of domestic gas in the CNG segment will be rising from 37% to 51%. Of course, we know that the APM gas allocation was cut by over 40% for some of these CGD companies in quick succession by the government. But this does come as some bit of a shot in the arm, right, for CGD companies. Nevertheless, after a very sharp fall in the last 2 months, most of these stocks have come off lows. Particularly for MGL, last 2 months the stock has gained somewhere around 10 to 12% or so. So this recovery that we have seen from lows, do you think that has more legs going forward? MGL, do you think it can retest its, can actually move higher from here, or do you think that people would use the recovery that we've seen in recent times to get out of the stock?
Absolutely. I think that last what you said about it is what I think, because it's quite regulated market or industry, and as that of our market as well, or maybe our industry as well, the financial industry is also quite regulated. But then this one has really seen fundamentally things not playing out in their side, and because of which we have seen the sharp drop coming in both of these stocks, and we have seen a good short build up out there as well. So derivative data clearly indicated that there are shorts build up. Whatever moves since then we have seen, Nandita, is on account of short covering or a technical bounce back, what we call. There are no such signs of things seems to have bottomed out, or maybe bottom is in place as of now. It's showing a bounce on a weak momentum. Data is not suggesting long build up, and fundamentally things have not still improved. As that it was earlier. Since this kind of measures have been taken by government, I think the overall outlook has changed. Until that doesn't change completely onto their side, I think people would be using this bounce to probably exit at whatever levels, higher levels, they're stuck, so that they can get into some better trending or growth stocks.
All right. Before I move on to other queries, we have quite a few of them. I've tried to take up as many as possible. But what do you do with the likes of SRF and Navin Fluorine? We saw, some of the other chemical stocks also doing extremely well yesterday. How would you approach these stocks after yesterday's up move?
That's true. The SRF bounced back quite sharply. In fact, as far as SRF is concerned, Nandita, I would say that it attempted to provide a breakout again from this range. It's been consolidating since September 22 within that range of, say, 2,900 on the upside and 2,200 on the downside. So it's almost 600, 700 points range. Yesterday it moved quite sharply with quite higher volumes, good long build up, and today we are seeing profit booking from the higher levels. I think the risk reward is not that favorable as of now. If it closes above the levels of, say, 2,700, then it makes sense to make a new lifetime high, or else you would find these stocks again at the lower levels. So buy on dips could be the strategy out there. Yeah, same is the case of Naveen Fluorine. But relatively, the risk reward would be better in Naveen because it has a support around the levels of 3600 and 3550 range. So as compared to SRF, I mean SRF will be confirming about 2700. Naveen would be like a good bet in the range of 35 to 30, 3550 to 3600. But all of that, the risk reward is more probably promising in Aarti Industries because on account of short covering out there. I mean these stocks have seen short covering long build up, and to get more volumes out here rather than one can focus
Hmm.
on stocks when it would be a good trading opportunity and short covering still pending. So hence I recommended Aarti Industries out there. But then for a longer term, yes, SRF is a good
Hmm.
stock to. Yeah.
All right, that's the view then on chemical stocks. Aarti Industries was a recommendation, but between SRF and Naveen, risk reward is favorable for Naveen. But let's take up some more queries then. Quite a few of them trickling in, and we can't take the same person's query every day because then it's unfair to the other viewers as well. So I'll try and take up some new queries, new people who've been writing to us of late. Bhumika Parik wants to know your thoughts on BEML. She already holds the stock at 4424, and she wants to know what should be done. BEML in tandem with other railway stocks, of course, we've seen a fair bit of correction, and her buy price is fairly high. What should she do?
Well, on BML, I think there could be some more downside left, Nandita, because see, what has happened in this stock is that we have seen the momentum peak out somewhere in mid of 24. We saw negative divergence in this stock, and then we have seen a sharp cut from say 5300 to 3500. So, the first two digits in fact reversed, 53 to 35, yeah. And then we have seen that bounce back coming on account of short covering until 4500, but since then the momentum has again weakened. It's on a weekly charts and monthly charts as well, the momentum has weakened. So for a long term, definitely it's a buy on dip story. Undoubtedly is what I believe for a long term. For a
Hmm.
short to medium term, I think that it can consolidate. So it's like sideways to negative. I mean, I cannot comment positive on this stock until and unless you see that kind of a move beyond 4500 or so, momentum turning back into the positive side. So I would be saying that if you are stuck, then any bonds, I mean, you can exit or maybe you can structure it in a way that you can exit somewhat now and somewhat on a bounce so that you get a proper exit because this stock might consolidate within a range of say 35, 3200 on the lower side to 4500 on the upside.
All right, that's the call on BML. Hope that answers your query. There's a query on TCS from Rishabh Tripathi. Rishabh, we've already discussed TCS, so you can just rewind the feed and perhaps catch Jay's answer. But the next query is coming in from RG, and he has a query on Indus Stars, which he purchased at 410 and exited with a loss at 360. He wants to know if it's worth re-entering the stock. What's your view? The stock has been in a downtrend.
Yeah, I mean, see, overall, we have seen the telecom outperformance quite a lot in initially, 24, but then since mid or maybe, the last 3 months of, 24, we have seen that kind of a profit booking coming, and I still think that, still somewhat correction out there is still pending. So Indust are still, I mean, it can bounce back, it has fallen quite a lot, but from purely from an investment point of view, I think, there is no such signs technically or from derivatives point of view, wherein I can say that there is a higher chance of a bottom in place. So I think along with the market, excuse me, along with the market, we would see some more consolidation to negative bias coming in this tower as well because the data is not that impressive on the long side.
All right, that's the view on Indus Towers. But let's shift focus to the next query then. It was on Siemens. Abhijit wants to know why has the stock of Siemens being falling despite good results? The stock has actually seen quite a bit of a sell-off, right? Over 21% down in the last 1 month itself. Where do you expect this stock to take support now?
See, Nandita, what has happened is cement had outperformed quite a lot. In fact, the markets fall as well. And it clocked in a new high in October, also almost retested the same in December. this is one of those stocks which really has outperformed the markets now. What has happened is the entire range of say 6,500 to 8,000 has been broken down, and that's a big range, 1,500 points. Even if you see 50% of the same, transiting on the low side, then 70, 50 points on the arithmetic scale. If you just subtract that from the lower end of the range of 6,500, still it could come to 5750. That's the minimum target what I can assume on the downside. Maybe thereafter it can fall 45, 55 or 55,000 levels as well. So yes, the trend has shifted clearly. I mean, we have seen that triple top or maybe a huge, what is a distribution pattern that got formed on the upside technically, and we have seen good amount of long unwinding and thereafter short getting built up as well. So from both technical and derivative point of view, I mean, it could be one of the shorts from here on as well.
Okay, that's the view on Siemens. Then hope that answers your query. But the very last query then I want to take up on an Arman Financial. This one's coming in from Geetu Sandesh. Wants to know if it's a good buy. This stock as well has seen quite a bit of a sell off in the last 6 months. It's almost half of its 52-week high. Do you see a case to buy this stock?
Arman Financial.
That's correct.
I do not track this. I won't be able to comment on this.
Sure, no worries, Jay. With that, I think we've come to the end of the query segment. Jay, I would like to thank you for taking out time and joining in. It's always a pleasure chatting with you, and I look forward to interacting with you again on our closing show as well sometime.
Likewise, always a pleasure.
Thank you. Thanks a lot. On that note, just wanted to take you through what the markets are doing. Thank you. Let's just look at what the markets are doing, because we have given up those feeble gains that we saw at the open. In fact, the Nifty has slipped below that 23,450 mark as well. We've broken below the December lows of 23,460, and a close below that, as our experts have also been pointing out, would actually confirm the downtrend, and perhaps you could retest lower levels post that. But 23,445 is where we are at the current juncture, not looking very good. Mid cap index has seen the sell off exacerbating. The mid cap index is down over 1%. The advanced decline ratio has worsened, and how? NSE advanced decline ratio is 1:7, almost 1:7. 297 advances to 1962 declines. So that's the kind of poor breadth that we are witnessing. It's the IT pack, although that's holding out. With top 4 gainers on the Nifty are from the IT pack: TCS, Tech Mahindra, Wipro, and Infosys. On the flip side, you have financials. They are taking a hit because the Nifty Bank index is very close to that 49,000 level as well. We are at the risk of breaking below that level as well, and it's not looking like a very pretty picture at the current juncture. On that note, let me also bring on board our next guest. Joining me is Anand K. Rathi, co-founder at MIRA Money. Anand, great to have you on the show. Wishing you a very happy new year and a prosperous one at that. From a market standpoint, not turning out to be such a great year, although we started on a positive note. But as I was just discussing with Jay, the party seems to be over. We have retested those December lows ahead of budget. Usually, we talk about a pre-budget rally coming in. Do you see chances of that fading?
Thank you, Nandita, for having me. Happy New Year. I definitely see that this trend will continue to be a little negative for some more time, till the time we see some positive trends, especially on the earnings that we are expected to see in the coming few days. There can be a pre-budget rally. There's always been a pre-budget rally in hope of expectations. But my belief is that this time the focus is going to be a lot more on the trend of Q3 earnings, and not so much about what RFM will do around this time. So my view is, if there's any kind of a support that the Q3 earnings show, then markets may stop falling, first of all, before it starts going up post-budget.
Sure. You alluded to third quarter earnings. The season has been officially kickstarted by TCS, and So far, so good. Although the numbers have been a mixed bag, it's the future outlook that has found favor with the street. In fact, it has also seen a upgrade coming in from CLSA. But if you compare TCS, within the IT basket, margins are expected to improve, due to the lack of any contribution to BSNL deal. But that will also weigh in on the top line growth, because for the last couple of quarters, it was the BSNL deal contribution that was ramping up the top line growth. But would you be concerned about how the company is looking at filling that gap, and would that cloud the outlook for FY26, particularly for TCS?
I'll answer about the sector in general, and of course TCS may be in a little more specific. But my view is that Europe as a continent is going to be a big pain point for the next couple of years. I don't see too much of growth coming in from Europe. Of course, US can be stable to a little higher. There's an expectation that if Trump cuts the corporate tax, there can be a little more movement of business to Indian IT companies. But that is something that we need to wait and watch for. But one thing is for certain, which is Europe is not clearly out of the woods. It's deep into trouble, and that can be bad news for a lot of these IT companies and most of the IT sectors in general. Earnings, as you rightly pointed out, the profit margins are looking better. So what we have seen is that the top line may not really grow at the pace at which it has grown. And generally, if you see the history also, Q3 has been the worst in terms of earnings, in terms of top line growth for most of the IT companies, because of two lesser number of days that they work for, right? These IT companies work for. So Q3 earnings, top lines, I think we should not read too much of it. We should look at forecasts. And we strongly believe that Europe is going to be a bigger pain point. Most of the IT companies should go to US. Maybe they will focus on Asia to build in their top lines.
But what about the mid-cap IT companies? Would you, veer towards mid-cap companies? And if yes, they've already seen a very strong run-up. Do you see room for more upside even if earnings, manage to beat expectations?
I think mid-cap IT companies are where a lot of these so-called good private sector companies were a couple of years back or last year. I don't see too much of an upside in most of the mid-cap IT size companies, but I definitely see stable, steady growth in IT as a pack in general. And during times when India has gone through a slowdown, during times when India has seen earnings not catching up, GDP falling, IT has generally acted as a good, contra bet for most of the people. It has hedged your portfolio against volatility. It has given decent growth. For that very same reason, even if I'm not very positive on, mid-cap IT companies or the overall valuation-wise in the sector, but I believe that it will act as a good contra bet and hedge, and that's why I would add that in my overall clients portfolio.
All right. Let's talk about some of the other sectors then. Banks, the updates that have come in so far have painted a mixed picture. Credit costs elevated, operating expenses also, pain point. Margins, of course, have been missing any which ways. How would you approach the banking space, and what kind of earnings performance are you expecting from them?
Yeah, I don't see too much of a credit growth that has happened in the last quarter. Banks, I think, in the last 2-3 years have been a good value trap. They have given at the price at which they are trading. Most of the banks have shown that they offer value, but when an investor goes and buy those banks, they tend to get stuck with most of the banks. But I think strongly that large cap banks, which have good, clean balance sheets, will start seeing good amount of growth going forward. It could actually translate to earnings in the next couple of quarters. Therefore, I'm not so bullish about not very well managed banks, but in general as a sector, large cap, well managed banks is something that I'm focusing on. I'm pretty positive that they will turn out to be a good bet in the medium to short term.
I want to get your thoughts on the consumer staples and FMCG pack as well. Yesterday there was a report by CLSA. They've taken an anti-consensus call on consumer staples, saying that the government capex both at the state and center level have been missing, and that could hint at shift in priorities towards boosting consumption. On that theory, should one look at FMCG and particularly the consumer staple names ahead of budget? And because they have underperformed quite a bit, right? Should one use this underperformance and take positions ahead of the budget?
Yeah, I also believe that it's a good contra bet. The Q3 earnings don't look very promising, to be honest, but I think market has already priced in a good set of bad Q3 earnings for consumer companies. And that's one of the reasons why we believe that at this price point, it looks good. The other reason why FMCG or consumer in general is a good bet is also it is a hedge against a lot of volatility in the market. Yes, the valuations are always high. If you look at their PE, most of the companies trade at obnoxiously high levels. But our belief is that the correction that they were overdue for has already happened. Maybe the downsides are not as much as we think going forward. Plus, if you added good prices in the next couple of years, you may see good returns coming out of FMCG pack, consumer pack, because too much of a negativity is, it would mean that the price is already factored in, and that would mean good returns over the next couple of years. So I'm okay to bet a certain part of my portfolio on FMCG as a pack.
Sure. Last question, really, Anand. If you look at the growth in demat accounts in the last quarter, third quarter, the growth fell to a 4-quarter low, and we've seen FNO curbs and volume slowing down, right? So that could be one reason. But on the other hand, yesterday we had SIP flows at record, and even equity mutual funds have seen a 15% uptick on a month-on-month basis. So that shows the resilience of the retail investor. But how would you be reading into these signs, particularly for demat account? Would you say that this is the start of a broader trend, or this is just a one-off?
You have answered it, Nandita. It is a broader trend. I think it's not one-off. In general, a longish downward-looking market has always led to a lesser amount of demat growth, because people, for the first time, I don't know how many of them saw for the losses for the first time in the last 2 years or so. So they are a little wary. They are not talking about this. I made so much returns in public, and that is leading to lesser word of mouth. And that's one of the reasons why you would see demat account openings are not going to be very high this entire year, is what my belief is. While on the other side, we run a wealth management firm. If you actually see the number of people investing has gone up significantly, especially in mutual funds, as the trend points out. Because what people have seen is that when you invest with a lot of discipline, it leads to good growth over a medium to short term, and they are not here for immediate return. So financialization of asset is something that will be there for the next couple of years at the same pace at which we have seen in the past. But opening up of demat accounts, trading volumes, maybe we have seen a bit of peak on it. The growth is going to be not as very high as we saw in the last 4 years.
All right. And the very last question then, at MIRA Money, which is that one theme that you guys have identified that could prove to be a wealth creator over the next 10 years?
Over the 10 years, I think it's too long a history. There is too much of a market dynamics that we need to keep in mind. But what we believe is that IT and pharma as a sector looks very, very strong for us. And that's one of the reasons why we have added it to our, aggressive sector portfolios. That has yielded us great result in spite of the fact that last year Nifty gave us 9%. IT as a pack gave us 20, 28, 29% kind of a return, and same applies for pharma. So if you are an aggressive investor, sectors are something that you can look at, and if you can actively manage it, I think that's one of the portfolios that a lot of people are keen on investing, and that's what we have identified for the next 10 years, 15 years, 20 years.
All right, IT and pharma, top themes for the next decade. With that, Anand, would like to thank you for taking out time and joining in. Have a good weekend, and I wish to connect with you sometime again soon.
Thank you.
Thank you. Well, on that note, the sell-off has only deepened. We are now below that. In fact, we are now staring at almost a triple-digit cut on the Nifty once again. Yesterday as well, it was a triple-digit cut. It's been a forgettable week for the market so far. We've already lost 2.5% on the index, since last Friday. So yes, we investors and traders will say, thank God it's Friday for that matter. But broader end of the markets also reeling under pressure. 1.5% kind of a cut coming in on the mid cap index. Not looking like a pretty picture at the current juncture, but it's the IT pack that's been giving some kind of support to the market at the current juncture. Well, with that, completely timed out on opening bell. Thanks a lot for tuning in. Stay tuned to Money Control for all your other news and updates.